The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box. I'm Karen Cho with Steve Sedgwick, and these are your headlines. President-elect Donald Trump ups the ante, vowing 25% tariffs on all imports from Canada and Mexico, and an additional 10% tariff on Chinese goods, citing concerns over drug trafficking and illegal immigration. Trump's tariff promise sparks a rally in the dollar, while equities climb, with the Dow, S&P 500 and Russell 2K all notching new record highs.
Elsewhere, Olaf Scholz is officially nominated by the Social Democrats to lead the party into next February's federal election, as the group trails in the latest opinion polls. And Germany's largest steelmaker, Thyssen Krupp, announces plans to cut 40%, I'll say that again, 40% of its workforce by the end of the decade, citing a spike in cheap imports from China. Good morning, Karen. How are you?
Good morning, very well.
I thought my last headline was juxtaposed beautifully, bookending beautifully your first headline as well. It's all about trade. It's all about Trump and the market movement. And we'll come to this throughout the show. We've got actually some real chatterbox guests, so they might get a word in edgeways because I might be quiet for once. But it's interesting, the market moving fairly aggressively on what it thinks Trump is going to do, isn't going to do, whether Besant is a calming hand or not as well. So I think it's fascinating to go into some detail on this trade story. So President Trump has vowed to, and he is president, by the way. I looked at the protocol, because you can say president-elect, but once you get an office in the United States, you keep that title for life. Unlike in the United Kingdom, for instance, the Prime Minister is only the current Prime Minister. In the US, of course, Obama's a president, Bush is a president, Trump is a president. So that's how we go. So Trump, who is president and president-elect, has vowed to impose an additional 10% tariff on all imports from China, far lower than the 60% he threatened whilst on the campaign trail. But it's nuanced, trust me. The president-elect also said he would sign an executive order on his first day in office, putting a 25% tariff on all goods imported from Canada and Mexico. So, tariffs. Trump tariffs, Democrats not tariffs, is not the case. Right. That is clearly not the truth. And actually, producer David has sent us all in our inbox a fantastic White House release from, I think it was May last year, May 14th, 2024. And it just shows you really how important tariffs have already been for the current administration. So I think for us to get into the mindset, Trump equals tariff equals great protectionism, Democrats don't equal that, it is wrong. And I'll just go into a little bit of detail on this, and then you'll come in, of course. President Biden, this is from the 14th of May this year. President Biden takes action to protect American workers and businesses from China's unfair trade practices. Really, all of you, do your homework. You can do it while you're watching Karen and myself. There's a lot in there as well, and there's a lot of levels. For instance, steel and aluminium, or aluminum as some of you might call it, under Section 301, tariffs will increase from 0 to 7.5% to 25% in 2024. Semiconductors to 50% by 2025, and I'm paraphrasing a lot of this. EVs, as you know, all of you, 100% in 2024, and it goes on and on and on. And it's fascinating, and it makes the point, and it really illustrates, so please do it. It's whitehouse.gov, briefing room statements, blah, blah, blah. It just underlines that actually Trump tariffs, Democrats not tariffs, is just plainly not the case.
Well, let's just add a bit more colour on that. So the Trump tariffs, I think, blanket is what we're talking about because they're country specific. The Biden administration tariffs are very targeted and designed in some way to really bolster the IRA to ensure homegrown industries. If you think about the areas where around solar, around batteries, or semiconductors, very much designed, EVs designed to grow future industries in the United States. This is very different to what Trump is proposing. But the question is whether this is just a an opening salvo in a negotiation with these countries designed to get them going on things like cracking down on drugs and also illegal immigration. Will he ultimately prioritise those two factors at the expense of the economy? Because there is a view by a lot of economists it will be at the expense of the economy by driving up the price that people pay for their goods when they go to Costco and Walmart, that those items that come through from China are very cheap and they do actually lower the cost of running a household in America. So there is a view that, look, inflation could come back. This on the back of Kashkari just yesterday saying they're still trying to assess over at the Fed which way inflation's going. They think it's obviously down. They think that borrowing costs are going to have some impact. So they're hopeful that inflation is going in the right direction. They're not looking at the cost of household goods at this stage. Don't forget that was well and truly rearview mirror. It was the services side where you're still seeing pressure, the housing side. If this were to change, it would be another element for the Fed, and therefore what impact would it have on borrowing costs, where already you've seen a little bit of heat since there was the Trump election victory. So if that were to continue, it drives up the borrowing costs for households, it drives up borrowing costs for corporate America and for the government. You, like me, like most people, are concentrating on the economics. Donald Trump is a television star before he was a politician. He was a reality TV star as well. He watches voracious amounts of TV. Now, that's not a criticism of the president. He does. And he looks, for instance, he's picked his cabinet, a lot of people say, on how they perform on TV. And okay, that's his modus operandi. I'm not making a critical point about that. But you mentioned two things there. You almost glossed over it because you're an economist by training. You looked at the economic side and the market side, and as we should do. But you mentioned immigration and you mentioned drugs. And I think the optics of which appear far greater on TV than the price of a can of beans going up or down as well. And I think the optics of these people caravans going through Mexico, attacking the border, the optics of dead Americans because of these despicable drugs, these fentanyl drugs. It's very, very visual when you look at the downtowns in some of these areas. It is appalling, the human costs as well. So whilst you are 100% right and our audience are educated enough, I know, to understand the economics and get that you're making the key point, it's the optics of the drug crisis, the optics of immigration that President Trump will also be looking at in equal magnitude. Yeah, what is the trade? And we've been through it on this side of the world, don't forget, even around Brexit. Economists were saying, look, this could be detrimental to the fortunes of the UK. And the reality was the referendum happened and people voted on a different element. It wasn't necessarily about their wallets. They voted on an ideology there, and they voted around concerns about the immigration, concerns about sovereignty, other pressing issues were there. So this can carry sway. The question is, for the Trump administration, will it be all dominant, or again, is it just a negotiation? But it's quite different to where we were yesterday when we were talking about the Treasury Secretary pick for Trump, Scott Bessent, who was seen as very positive for the markets because it felt like some of the potentially wild, unstable elements of Trump on campaign trail would maybe not materialize in office. But I think that is quite a different narrative to today as we digest this. The lesson learned from Trump season one, and I'm taking the phrase from someone else, Scaramucci actually. Season one, Trump season one, you didn't know whether what he did and what he said were the same thing or completely opposite. The thing that we've all learned from Trump season one, and again, this is the rest is politics. It's a brilliant podcast, Caddy K and Scaramucci. Basically saying the difference between what he says and what he does, that's the key for season two, so we can all understand Trump a little bit better. But let's get another voice on this one anyway. Yeah, I think there are market ramifications here. Max Kettner joins us, Chief Multi-Asset Strategist, HSBC. Max, I was just making the point that I think for markets today, it's quite different to even 24 hours ago, that they now have even more risk, more concern about what happens when the Trump administration truly takes hold. What do you make of the concerns around trade tariffs and the impact on equities that are trading around record high stateside?
Yeah, good morning. Look, I don't take that an awful lot seriously. It might sound very, very crazy, but I think what we are in right now, we're in an environment where, again, we're really, really focused on day-to-day politics. Similar to 2016-17, if we talk about season one, like Steve was calling it, we look at Trump season one. It was also very easy to get bogged down into the day-to-day politics, really, and not really focus instead of what's driving markets really, because what is driving markets is not the day-to-day politics. It's the policy setup. It's what happens with rates, right? It's what happens when we look at the Fed. Okay, we're still going to get these rate cuts. They might be more gradual. The end point might be higher than we thought perhaps 3-4 months ago, but we're still going to get those rate cuts. we might even see an end to quantitative tightening next year. We've been talking about for 3-4 quarters now that obviously the US economy is slowing down. And in reality, when we look at the data, it's just been growing pretty steadily, around about 3%. That's the starting point. We've just had a month and a half ago the revisions to the national accounts data, where randomly we almost found another almost $1 trillion in real disposable income in US consumer pockets. I think that from a market perspective, from a driver's perspective, is the much more important point. And the day-to-day politics is literally that proverbial wall of worry that we continue to climb day after day. We're like, well, what happens if he does this? What happens if he does that? What happens if the administration puts on this tariff on that good? And it's like, well, this hasn't happened. So maybe the S&P has to go another 0.5% higher and another 0.5% higher. So it's literally that proverbial wall of worry, which is the day-to-day politics. But if we look from a 6-12-month perspective, the actual driver of market is not the day-to-day politics, it's the policy setup.
Max, let's talk about that confidence game though, because nothing seems to be rattling the confidence of market at this stage. But if you talk about a wall of worry, and you've got companies here that now have more uncertainty than they've had previously, we talk about tariffs, blanket tariffs across on the northern and southern border and also across to China. Doesn't that rattle some of the market confidence?
I think it would if we didn't have anything priced in, right? If this was a complete surprise, I think you'd be absolutely spot on. However, when we look in the run-up to the elections, look, for example, at some of those tariff baskets that people have put together, companies that presumably would be a bit more affected by tariffs versus those ones that would be relative beneficiaries. Those baskets have moved an awful lot. We've seen the run-up in yields, of course, in the run-up to the elections as well. So I would argue, both on the equity side, from a relative value perspective, an awful lot is in the price. An awful lot is in the price also with regard to equities. For example, in Europe, we've seen a big underperformance of Eurozone equities against Eurozone credit, which is, again, speaks in favor of a lot of the worries already in the price in the equity market in particular. We, of course, only or tend to focus a lot on the S&P 500, given its sheer weight in the global equity market now. But when we look a bit more nuanced in the relative value, regionally or from a sector perspective, I would argue an awful lot has already been priced in since the end of September. So there isn't an awful lot of basis for saying, the equity market has to tank by 10%. Because again, ironically, what the current focus to the day-to-day politics does, it actually keeps sentiment and positioning in check. Right? You're not going to I don't think you'll find an awful lot of 2025 outlooks where either the buy side or the sell side will be writing, we're absolutely risk on. We're buying everything in equities. We're max long risk. You're probably not going to find that because there is too much seemingly and allegedly too many worries about what is the day-to-day politics going to bring.
Max.
And that is the most crucial thing.
Max, the Russell 2K hit a record in the previous session, as Karen's been mentioning. 6 out of 7, six in a row for the first time in quite a while. Is this rally, are we typifying the rally in the wrong fashion, that it's tech? And I appreciate the percentage of double-digit gains in the earnings season that have come from tech is, once again, skewing the figures. But when I look at the Russell 2K, for instance, at record highs, I look at Walmart, up over 60% this year. I say to myself, this ain't just about technology.
Absolutely. I think absolutely. I would still be overweight in tech. I'd still be for the next couple of months liking tech. Actually, also quite like healthcare, but a bit of a mini reflation trade almost, so industrial as well. I quite like the US banks as well, but it's not just about tech anymore. However, when we look at the Russell 2000, I think the rally in the Russell 2000 specifically, that to me is short-lived because we've always got to remember it's an index where more than 40% of the companies don't make profits. So frankly, if a bullish view like mine, if a constructive view like mine turns out to be incorrect, then you have almost half of the companies sitting on negative earnings. And that is not a great setup for if indeed a constructive view turns out to be wrong. On the other hand, if the view that I have turns out to be almost too correct and yields have to back up again, you have this very, very large floating rate debt exposure in the Russell 2000 as well. So on both sides, I'd rather go into mid caps. I'd rather go to something like the S&P 400, rather go one step down to the S&P 400, rather position a bit for the mini reflation trade cyclicals within the S&P 500 rather than going all the way to the Russell 2000.
Max, what about the other compelling narrative at the moment is Europe's getting left behind economically, on the markets, and with a vast amount of political consternation as well. Is the discount, which is multi-year highs, if not record levels in some cases, that Europe is trading at versus the US, is this a great opportunity or a value trap?
So we've got to talk cross-asset here, because the trade to me is in FX and in rates. It's a trade where I want to be, particularly after the last 2 days, perhaps loading up on euro shorts again. It's a trade where I think there is still some space versus bonds versus treasuries. So that's where you can play all this stuff that you just said. Europe is being left behind. European potential growth, the Eurozone in particular, potential growth rates have been plummeting the last 15 years. Now the structural reasons, Germany and so on and so on. That is a trade for rates and FX. The trade in credit, however, when we look, for example, at Euro high yield, nowadays it's only 6% of Euro high yield is in triple Cs. So you could argue the high yields, the Eurozone high yield universe is actually much more conservative, much more defensive compared to, for example, 10 years ago. It's not a trade that you can do in credit. And lastly, when we look at equities, again, I don't think that's the trade in equities, because what we've seen in equities this year, remember the famous granolas, remember where people were pushing these large caps and the mega cap equivalents to the Magnificent Seven in Europe just a year and a half ago. And when we look at all those names, look at the mega caps, look at Nestle, which is food, right? When we look at ASML, this is tech. We look at LVMH, which is luxury. We look at things like Novo, which is pharma. All of those names have been really, really lagging in the last 6 to 12 months. And contrary to the Magnificent Seven, they don't have a similar driver. The Mag 7, you can give or take, you can say they're all pretty much driven by one common driver. In Europe, and particularly in the Eurozone, it's really tricky, because it's not about the politics. It's not about the economics. Again, that is a trade in FX and rates. But in Europe, you're making a call that the mega caps will work again, which are all driven by different factors. That's very tough.
Max, it feels like some of those granolas got eaten for breakfast. I want to take you to your commentary, your highway to the danger zone 2.0, this note from HSBC, because we've been closely watching those yields stateside. And the other big story around the incoming Trump administration is the promise to extend those tax cuts. Now, there's been all sorts of number crunching around this. Tax experts saying it could add $4 trillion to the current $36 trillion US debt over 10 years. There's a view that, look, of this whole Republican theory of growing our way to strengthen the economy, and that pays for itself. But analysis shows that the $1 trillion has been added to deficits over 10 years from this tax break that has been offered up. So in fact, if anything, it's not growing the economy and paying for itself. It's just a cost. It's a borrowing cost. So what is the danger zone here for yields, even if we've backed away from that 4.5% mark for the moment?
Yeah, Karen, like you said, the danger zone to us starts at 4.5%. I think that the big danger for equities, for credit spreads, for emerging markets assets, really for risk assets in general, is not only the level, but also what would be driving a backup in yields. If yields really were to put above 4.5% or pushing towards 5% again, if that is a reflection, let's imagine, for example, a reflection of much better growth. Let's imagine a scenario in the next couple of months where election-related uncertainty now gone, small cap surveys go up, hiring picks up again, regional Fed service, even manufacturing things, all these sorts of things are starting to improve again. If that happens, and we see yields on the long end backing up because of a reflection of better growth, that need not be bad news for risk assets. The bad news is, just like you said, if you have particularly the term premium picking up, because that is literally just a cost. So to me, it's not just about the 4.5%, it's also what is driving that. If that is particularly the term premium, if it's just a cost reflecting neither higher inflation, which is reflected in nominal earnings, nor better growth, which is again reflecting in better earnings. If it's just the term premium, that's literally just a cost. It's not compensating for anything. That to me would be really the biggest danger in the next couple of months.
Max, thank you very much for joining us today and spelling out some ideas for our investors. Max Kettner with us, Chief Multi-Asset Strategist at HSBC. A quick look at the markets and Asian markets as they weigh up the potential for tariffs on China, extra tariffs from the incoming Trump administration. You can see there is some weakness cropping up across the board. The Japanese stock market in particular, we are seeing selling there to the tune of more than 1%. The Kospi is moving south. TAIEX in Taiwan down more than 1%. Hong Kong stocks still holding on to some green, but it's a reversal for Shanghai, down about a tenth. Nifty 50 is flat, and you've got Jakarta trading a little bit lower, along with the Straits Times index down by about 0.1%. So mostly across the Asian markets, looking at the impact on supply chains. To the dollar, and it has been a firmer dollar story that we've witnessed as risk aversion settles into the markets. Euro dollar, sterling both on the back foot, sliding more than 0.1%. Dollar gaining versus the Japanese yen, marching up by more than 0.25%. And dollar Swissy, it is a firmer trade there as well. To treasuries, and what we're seeing underlying this has been a flip back into the green for these yields that had been moving into the red on hopes around Scott Bessent being the next US Treasury Secretary. But we're 4.29 on the 10-year this morning and 4.27 at the short end, the 2-year. To the US markets, and we mentioned some of the fresh records. Well, the Dow really out in front, rallying close to 1%. A number of big stocks are moving the needle on these major boards. For the Dow, it was United Health. For the S&P 500, it was Apple. And across on the NASDAQ, it was Amazon. So a real mix of major players. And if you look into this market, it was out of the sectors, industrials, financials at fresh records, again by the finish, and real estate marking high, one of the better performing sectors. So real breadth coming back into this market as we can see record territory and too on the S&P 500. US futures, can it be sustained is the question. You can see not a huge amount of momentum at this early hour, but still indicating that the market's not ready to hand back these newfound gains.
Coming up on the show, the SDP stands behind German Chancellor Olaf Scholz, nominating him as the party's candidate ahead of February's federal election. We'll take a look at his chances. Plus, Pictet Asset Management warns economic growth in EU and China will continue to disappoint next year. We'll talk through their outlook later this hour. And don't miss our interview with the CFO of Thales, that's Pascal Bouchia, as the French defence giant sets an ambitious sales target for the next 4 years. That interview coming up in 39 minutes' time.
German Chancellor Olaf Scholz has officially been nominated by the Social Democrats to lead the party into next February's federal election. The party's committee unanimously backed Scholz after Defence Minister Boris Pistorius ruled himself out of the running last week. Scholz said he was not concerned by previous reservations about whether he is the right candidate to lead the SDP party into the election.
Those who have spoken out publicly are behind me and behind this decision. I discussed it with all of them and they also told me of their own accord. I thought it was okay that there was a brief pause for a discussion over whether I was the right candidate for the party. But it is a good feeling to know that we have paused together and have now made up our minds and want to achieve together what we succeeded in doing last time, namely that the citizens of this country voted for the SPD to become the strongest party.
The latest polls have the SPD party sitting in third with 15% of the vote, trailing further behind the Christian Democrats as well as the far-right AFD.
Thyssen Krupp is slashing some 11,000 jobs at its steel unit. That is around 40% of its workforce. It comes as part of a series of cost-cutting measures, with the German industrial group warning overcapacity and cheap exports out of Asia have placed considerable strain on competitiveness. Annetta, I could almost cut and paste, take out Thyssen Krupp and put in a whole host of other names from the German industrial sector at the moment for that story as well. But I don't know if you want to start on Thyssen or you want to make a comment also on Herr Schulz as well. The comment around from some educated people far better than me is that Schulz is basically the sacrificial lamb, i.e. there's no point in wasting Pistorius in an election the SPD are going to lose anyway.
Well, one could argue like this, but one could also argue that Scholz is really He just wants to stay in power, and I think that's one of the main takeaways from that race. And Pistorius, obviously, he has no expertise in economic affairs and no expertise in social affairs, and so I guess they didn't just want to have that power struggle in front of everybody. So Pistorius did go away, but perhaps he might come back at a later point in time, because clearly the popularity of Olaf Scholz is very low, and that will also most likely drive the election results in February when we have snap elections. Of course, let me go on to Thyssen Krupp. Thyssen Krupp, we have been waiting for that restructuring plan for, I guess, years now. That it is so drastic, it is also a surprise. And of course, trade unions are protesting now against this. But given the situation worldwide, I think the whole drama started in 2017 when the regulator in Brussels didn't allow a merger with Tata Steel to actually create a big European or half European champion when it comes to the steel market. But now they just can't compete. They are no longer competitive. The steel prices are low and they are not going to recover. They can't do much more. And that whole transition into green steel will not yield much more demand. So essentially, and you're right, it's just one of a couple of other companies, Bosch, Volkswagen, ZF Friedrichshafen. So it's the car sector, but also the old traditional industrial sector who are shedding jobs in thousands. I haven't been counting, but it's more than 30,000 jobs which have been gone, or at least announced to be cut in the last couple of weeks.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.